All right, welcome. So in finance, we're all trained to think about the hard stuff, right? Fundamentals, data, rational actors, all that. But what if one of the most significant yet kind of overlooked factors influencing multi-billion-dollar decisions is something as simple as the weather? I know, sounds a little strange, but let's dive into this because the data is going to surprise you.
I mean, let's just ask it straight up. Can a sunny day really move Wall Street? It almost sounds like a joke, doesn't it? The idea that the New York Stock Exchange could be swayed by cloud cover, well, it seems to fly in the face of everything we learn about efficient markets. But this is exactly the kind of weird, wonderful question that behavioral finance forces us to confront. And believe it or not, the answer, backed by a ton of research, is a pretty resounding yes. So let's unpack the evidence. We're going to look at exactly how our moods, which are definitely influenced by the weather, create these tangible, predictable ripples across the entire financial system.
So, how in the world does this actually work? Well, it all starts not with finance, but with just basic human psychology. This link between the weather and our internal state, that's the engine driving everything else we're about to talk about.
The core idea here is actually really direct. When it's sunny, people genuinely feel more optimistic. We're more active, and we're just more willing to take a chance. Now flip that. Cloudy, gloomy weather, it tends to bring on more pessimism, a bit of inertia, and we become much more risk-averse. This simple emotional shift is the absolute key to understanding the financial effects that follow.
Okay, so we've got individual feelings, but how does that scale up to actually moving markets? I mean, if enough traders in New York or London are feeling a bit more optimistic just because the sun's out, can that really show up in stock returns for the day?
Well, this quote right here is the landmark finding. This is the big one. Hirsch, Schliffler, and Shuey published this in the Journal of Finance, a top-tier journal, after looking at data from 26 different stock exchanges all over the world. And what they found was a statistically significant link. More cloud cover was related to lower daily stock returns. This was the academic proof that really put the weather effect on the map for good.
Now, I know what you might be thinking. Okay, fine. Maybe this affects some retail day traders. But come on, not the seasoned professionals, right? Well, you'd be surprised. The research shows that this cognitive bias is remarkably democratic. It hits even the most highly trained decision makers out there.
And just look at how wide-ranging this is. Financial analysts, they're actually less productive on bad weather days. Institutional investors, we're talking the really big players, they are measurably slower to process important company news when the weather is gloomy. And this one is just incredible. Loan officers are statistically less likely to approve a loan application if the weather is bad in their specific county that day. These aren't just little quirks. This stuff influences the core functions of our financial system.
So we've seen weather hit our psychology, and we've seen it hit the financial markets. But does it stop there? Or do these mood-driven decisions actually spill over and affect the real, Main Street economy?
Oh yeah, they absolutely do. Take a look at this chart. It's based on asking small business managers a simple question. Is this a good time to expand? And you can see it plain as day, they are way less optimistic on cloudy days. And this isn't just a feeling. Research shows this pessimism translates directly into fewer hires and less investment at the state level. It has real consequences.
And it's not just small businesses. You see this pop up in the housing market too. It turns out that a nice, sunny day during a home auction can actually lead to higher final sale prices. It seems like that sunny disposition just makes buyers willing to bid up a little bit more. It's wild.
Okay, so this all brings up a really important question for us as finance students. Can we actually measure this? Can we put a number on a stock's sensitivity to these big, weather-driven mood swings? The answer is yes, and the concept we use is called mood beta.
Think of it like this. You know how a stock's regular beta measures its sensitivity to the overall market? Well, a stock's mood beta measures its sensitivity to shifts in investor sentiment. It's a really cool tool for capturing this specific kind of behavioral risk.
So what does this mean in practice? Well, what we find is that stocks with a high mood beta, you can think of these as more speculative, maybe growth-oriented companies, they tend to significantly outperform the market on sunny days when everyone's feeling optimistic. But on cloudy days, there's really no significant effect. This shows us a quantifiable and maybe even an exploitable pattern that's being driven entirely by sentiment.
And that really brings us to the big takeaway here. The weather effect is just this powerful, powerful reminder that markets are not these sterile, perfectly rational machines. They're driven by people. And if something as simple as the sun and the clouds can have this much influence, it forces us to ask a much bigger question. What other fundamental, yet totally unseen, human biases are shaping our economic reality every single day? Something to think about.